Welcome to Iron Financial, the only place where we forge stronger portfolios by cutting through market meekness. Today, we are putting on the safety glasses and grabbing the hard hats because we are tearing down one of the most controversial earnings reports of the quarter, Alibaba. Look, the stack took an absolutely massive hit after hours, and you can feel the panic on the street. So our job is to figure out if they're looking at a building on the verge of a total collapse or if they're just missing the blueprint for a skyscraper. This is a high-stakes teardown, and we are going right to the source. Okay, let's not get ahead of ourselves. The blueprint doesn't matter one bit if the foundation is cracking right now. The market, it isn't subtle, and its first reaction was a straight-up gut punch. Just look at this headline from investing.com. Alibaba shares fall as earnings and revenue miss estimates. I mean, that's not a signal, that's a siren blaring. The market saw the numbers, and it ran for the exits. So before we start talking about some grand 5-year plan, let's talk about the damage that's actually happening today.
And he is absolutely right to point to the damage. You can't ignore it. You can't just brush this stuff aside. Okay, let's dive into this. Here is the first number that sent shockwaves through the entire market. GAAP net income. It collapsed by 66% year over year. 66%. That is a brutal, just an undeniable figure. For a company of this scale, seeing 2/3 of your net income literally evaporate in 1 year is enough to make even the most seasoned investor break a sweat. This was the first heavy blow, and believe me, it landed squarely on the chin.
And it wasn't a fluke, right? This wasn't just some accounting trick or a one-off. Look at this next slide. Adjusted EBITDA, and this is the number Wall Street watches to see past all the noise and get to core operational profitability, it's down 57%. So this tells us that before you even get to interest, taxes, and all the other accounting stuff, the fundamental business is just generating far, far less cash. This isn't about one-time charges. This tells you the core engine is sputtering. Seriously, when both your GAAP and your adjusted profits fall off a cliff like this, it raises a really serious question. Is the whole machine just breaking down? Are they losing their grip on the fundamentals of the business? I mean, from an operational standpoint, this is a 5-alarm fire. Exactly. And the direct consequence of those two massive numbers is what we see right here. The stock getting hammered almost 5% in after-hours trading. This is the market's immediate, visceral reaction. It sees collapsing profits, it sees a revenue miss, and it just sells. It doesn't ask questions. So the crucial point we have to wrestle with is this. Is the market correctly identifying a company in terminal decline, a value trap just waiting to spring on hopeful investors? Or is it overreacting to short-term pain and completely missing a massive, long-term strategic pivot? Honestly, that is the billion-dollar question we have to answer. So to get to the bottom of this, we need a disciplined approach. We need a plan. Here's our roadmap for this teardown. First, we're going to examine the market's verdict and really understand exactly why the street punished this stock so severely. Then we'll do a deep dive into the core engine under siege, looking at their bread and butter, the China e-commerce business. After that, we're going to shift to the future and analyze how they are forging the AI behemoth. We'll then stress test their finances in the war chest to see if they can even afford this fight. And finally, we will deliver our verdict. Is this a company being rebuilt from the ground up, or is it actually headed for ruin? All right, I'll take the lead on this one because, frankly, it's simple, and the market isn't wrong. The punishment absolutely fits the crime here. Investors aren't panicking without reason. They are reacting to a series of undeniable red flags that came screaming out of this report. This isn't about feelings or sentiment. It's about math. And right now, the math looks ugly. So let's break down the headline horrors that caused that massive sell-off. Just look at this control panel. Every single light is flashing bright red. It's a clean sweep of negativity. First, revenue, it missed expectations. In a market that is obsessed with growth, that's a cardinal sin. You just don't miss the top line. We've already talked about the catastrophic drops in net income and adjusted EBITDA, which is just pure operational weakness. But the real kicker for me is that last one. The profitability of their China e-commerce group, the very heart of the company, fell by 43%. This isn't some problem in a speculative side business. The fortress itself is showing stress fractures. So when every single key metric is screaming sell, that stock price drop looks less like a panic and more like a perfectly rational repricing of risk. Okay, that is a powerful bear case. It really is. But it all rests on one critical assumption, that this damage is accidental, that this is a sign of a company that's lost its way. I want to propose a different question. What if this isn't a sign of weakness at all, but actually a display of strength? What if management isn't losing control, but is actually steering the ship directly into a storm on purpose because they know there's a treasure on the other side? Is this pain a symptom of failure, Or is it the calculated, intentional cost of a complete corporate reinvention?
And to answer that question, we have to start where the pain is most acute, the core engine, the China e-commerce group. This is the cash cow. This is the fortress that has funded all of Alibaba's ambitions for more than a decade. And, as the skeptic rightly pointed out, its profitability just cratered by 43%. So, on the surface, it really does look like the walls are crumbling. But if we look inside the numbers, a very, very different story starts to emerge. A story of deliberate sacrifice in the face of some really intense competition.
Look at this table very carefully. It tells a crucial part of the story here. The revenue for the group is actually up 6%. The top line is stable, it's growing. The problem isn't that customers are fleeing. The issue is the massive divergence between that revenue line and the profit line. So you see adjusted EBITDA down 43%. The big question is, where did all the money go? Well, the report gives us the answer loud and clear. Massive reinvestment, specifically into their quick commerce business, which, by the way, saw its revenue explode by 56%. They are intentionally taking the high-margin profits from their legacy business and plowing every single penny, and then some, into this new high-growth battleground. And that's a strategy, I'll give you that. But is it a smart one? I mean, really. They are taking the financial foundation of the entire company, a predictable, high-margin business, and they're weakening it to chase growth in a notoriously brutal, low-margin, cash-burning war against entrenched competitors like Meituan and JD.com. It's like tearing down the load-bearing walls of your fortress just so you can build a catapult. Yeah, it might look aggressive, but you risk bringing the whole structure down on your head. They are essentially telling shareholders, hey, trust us, the profits will come back someday, while they pour money into a street fight for delivering groceries in under 30 minutes. That's a really tough pill to swallow when you see a 43% profit drop today and you know that competitors like PDD are growing even faster and are just as willing to burn cash to gain market share. This isn't just an investment, it's a huge bet that they can outspend everyone in one of the toughest markets on earth. That's a fair challenge, and you're absolutely right to highlight the brutality of that quick commerce war. It is a meat grinder. But what if that bloody street fight is only half the story? And frankly, it's the smaller, noisier half. What if the investment there is partly just a defensive move, something designed to keep rivals busy, while Alibaba's main army mobilizes for an entirely different war? You see, the real reason for the profit collapse and the core of the bull case has nothing to do with delivering groceries faster. It's about a pivot so massive it completely redefines the entire company. We need to stop thinking of Alibaba as just an e-commerce giant. They are using this moment of perceived weakness to forge themselves into a full-stack AI behemoth. This is where the real heavy lifting is being done. To really understand their ambition, you have to understand this concept, a full-stack AI strategy. This is not about creating a single chatbot or licensing a model from somebody else. No, this is about total domination. It's a strategy to own and to control every single critical layer of the AI value chain. It starts with the silicon, the actual chips that power this revolution, and it goes all the way up to the apps that you and I will eventually use. They don't want to just play in the AI sandbox. They want to own the sandbox. They want to own the sand, and they want to own the factory that makes the pails and shovels. And this just brilliantly illustrates their methodical approach. It really is like building a skyscraper. Step 1 is the foundation, the chips. Their TIAD division has already shipped 470,000 AI chips. This is not a plan, this is already happening. Step 2 is the structural steel, Alibaba Cloud, which provides the raw compute power. Step 3, that's the wiring and the plumbing, their proprietary Qwen AI models, which, by the way, have already surpassed 1 billion downloads on Hugging Face. And then step 4 is the finished interior, the applications like Token Hub for developers and Wukong for enterprise, all built on top of their own stack. You see, each layer is designed to reinforce the others, creating an almost insurmountable competitive moat. And if you think this is just some PowerPoint strategy, you need to look at the numbers. This is the proof that the investment is actually working. External cloud revenue growth is accelerating. It hit 35% this quarter. Revenue specifically from AI-related products is growing at a triple-digit rate for the 10th consecutive quarter. Let that sink in. This isn't a new trend. It's a sustained explosion in demand. And as a result, their market share in the cloud is growing, now standing at a dominant 36%. The engine isn't just built, it is firing on all cylinders, and it is gaining speed. And this all culminates in the single most important number for the entire bull case, a number that CEO Eddie Wu dropped on the earnings call. $100 billion. That is their 5-year target for combined external revenue from their cloud and AI businesses. To put that into perspective for you, that's larger than the entire current market cap of many major tech companies. This isn't a pivot. This is a declaration of war. They are aiming to build a brand new company, a $100 billion company, inside the old one. Whoa, hold on a second. $100 billion target is fantastic. It makes for a great headline, I get it. But it's a 5-year plan. Shareholders are feeling the pain now. My 401k is down today. The earnings report shows that these massive investments in AI initiatives are a primary reason for that 57% drop in EBITDA. They're spending billions on Qwen models and consumer-facing Qwen. So the question that every single investor has is simple. When does this dream stop burning cash and start generating actual tangible profit? Because right now, from where I'm sitting, it looks like a very, very expensive science project.
And that is the perfect question. It's the right challenge. Can they afford this war? An ambition this big requires a war chest to match. And this brings us to what might be Alibaba's single greatest competitive advantage, its fortress balance sheet. The ability to fund this transition isn't based on hope or some future debt offering. It's based on a mountain of cash they already have. So let's examine if their financial foundation is actually strong enough to support the cost of all this construction.
This slide frames the entire debate perfectly. On the left, you've got everything the skeptic and the bears are pointing to: the cash burn, the heavy losses in quick commerce, the aggressive R&D spend on AI, the cost of scaling all these new apps. It's a real and it is a significant drain on resources.
It's a bonfire of cash. That's what it is. They are lighting their profits on fire in two of the most competitive industries on the entire planet.
But on the right, you have the financial fortress that makes all of it possible. They have over $60 billion in net cash. Let me repeat that. $60 billion. And despite all this investment, they are still generating positive free cash flow, RMB 11.3 billion this quarter alone. They aren't just surviving this investment phase, they are self-funding it. And this gives them the confidence, as their CFO stated, to reinvest for long-term growth without having to answer to nervous creditors or the whims of the market every single quarter.
Okay, so we've seen the red flags that have spooked the market. We've dissected the intentional sacrifice happening in the core business, we've laid out the colossal ambition of their AI strategy, and we've confirmed they have the financial firepower to fund it. Now it's time to step back, weigh all the evidence, and deliver the verdict. Is this company showing fatal cracks in its foundation, or is it forging a new steel frame for a much, much taller structure? Rebuild or ruin?
Look, the bear case is crystal clear, and it's grounded in the reality of today. These are the cracks you can see and touch right now. Profits haven't just dipped, they've collapsed across the board. The cash cow, their core e-commerce business, is being intentionally weakened, which is just an incredibly risky move in this competitive market. The cash burn for these new ventures is massive, and management has given no clear end date, no light at the end of the tunnel. And the market despises this kind of uncertainty, which is exactly why the stock is being punished. And let's be blunt, a $100 billion goal is just a target, it's not a guarantee. It could very well end up being a $100 billion mirage that was built on a giant pile of shareholder money.
But the bull case argues that you're looking at the rubble and you're missing the steel frame being erected right in its place. This profit drop is not a sign of failure. It is the cost of investment, a down payment on the future. And that investment is already paying off with explosive triple-digit growth in the AI segment. This isn't some random bet. It's a meticulously planned full-stack strategy that is designed for total market dominance. And they can afford it because of their $60 billion war chest. So the crucial point here is that management is making a conscious strategic trade. They are sacrificing today's easy profits for a chance to absolutely dominate the single most important technology market of the next generation.
So here it is, the iron financial verdict. This is not a collapse. This is not a company that's losing its way. This is a controlled demolition. Alibaba's management is intentionally tearing down parts of its old, profitable, but slower-growing business structure to clear the ground. They are doing it to build something far larger, more strategic, and ultimately more durable in its place, a fully integrated, AI-powered titan. The noise, the dust, the collapsing profits, it is all part of the plan. And this leaves us with the final, critical question. And it's not for us, it's for you. A controlled demolition is messy, it's loud, it's ugly, and it's dangerous if you don't believe in the blueprint. The market is looking at all the rubble, and it's running away. The bull case is looking at the architect's plans for the skyscraper that's to come. So the ultimate question for any investor looking at Alibaba today is this: do you have the conviction and the stomach to walk onto an active construction site knowing it will be years before the building is finished? Your answer to that question will determine whether you see this as a trap or the opportunity of a lifetime.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.